So today we need to talk about how far can stocks fall. It's the number one question I've received over the past week or so, rightly so. And I will just say this, and I have one really important chart that I'd like to share with you guys. It's right there. You won't probably see it. I'll show you in a minute. But we've been sort of raising the cautionary flag now for weeks, months, and actually for quarters for clients, depending on their duration of their portfolios. I do think that stocks ultimately could see another year-end rally, but broadly speaking, things aren't looking good. And I think there's quite a bit more downside. That doesn't mean it has to happen. Of course not, anything can happen in the market, but the odds of a further downside move right now, in my opinion, are more than people think. We had extensive research calls yesterday with our hedge fund and family office group, and here's what we came up with. So let me give you a bit of an idea of what we're thinking about. So let me flip the camera and go straight to the chart. Now, before you freak out about this chart, it's actually very straightforward and simple. I'm going to walk you through it right now. This is really important. Okay, what we're looking at is the S&P 500, at least generally speaking. So the S&P 500 is this line here. Okay, and you can see how we basically overshot here once in January, and then once again for the rest of the year. And we've been mean reverting now a couple of times. Now, one of the main things that professionals look at is market breadth, and meaning like how many stocks and how many parts of the market, how many sectors are actually going higher with the broader market. So the S&P 500, for example, I'll go back to the chart in a second. In September, when it broke out, actually did so only with two sectors supporting that move. I believe it was consumer discretionary and technology. The rest of the market, as you guys will see in a minute, basically made lower highs. That's not good. So we might have seen a breakout, fake out, or maybe like a double top is what some people might refer to. So let me show you. So if you focus for a minute on this blue line up here, that is the New York Stock Exchange Composite, which is a much broader range of stocks, or a much larger group of stocks than the S&P 500. I think it's like almost 2,000 stocks. And you can see that it made a notable lower high here in September versus the January highs that we saw earlier this year. Taking this even further, down here what I added is just a few sectors, the most prominent ones like industrial stocks, material stocks, and financials. And look at all of those also made lower highs in September. Again, not what the S&P did, because the S&P made a higher high, very marginally so, and it was a big fake out breakout. So what do I think, how far we can go? I think right now the risk is that we fall somewhere into the middle of this channel, which is about another 10% lower, maybe 2,500. Now, does that mean it has to happen? No, it doesn't. But if we see a risk-off move and people start to get rid of large cap tech names, is really kind of what we're looking for to maybe trigger this, we could absolutely see a more sort of like a snowball effect. I'm not saying it has to happen, but I think the risk is there. So what we've been telling clients, we think from a research perspective, it's a good idea to raise cash. Now, everyone's got different portfolios. That is not financial advice. I'm just telling you from a risk management perspective, that's probably a smart thing to do through a multi-quarter lens right now. I do think ultimately we'll see another year-end rally. It's entirely possible. The question is from what level? Could it happen? Could we start bottoming out today and start rallying? Absolutely, we could. But I think the risk right now of further downside movements, and again, I think in the S&P we could see a 10% drop. It's not out of the question. I'm not saying it has to happen, but I think the odds are now higher than they were probably at any point over the past, like say, 2 years. Okay, and we've already dropped about 7% as of today, or roughly in the S&P from peak to trough, but there's not a whole lot. So another 10% would get us to about 22 or so percent, which I think, again, it's not something a lot of people are positioned for, but what we're seeing and what we're telling clients, that this is just one part of the analysis that I'm giving you guys here for free. But if you were to look at a little deeper, the evidence is even more so in favor of lower prices before we get an opportunity to buy into year end. So take that for what it's worth. Again, I'm not saying it has to happen, but I think the odds are higher than they were over the past couple of years or so. And so we want to be prepared for potentially lower prices ahead before we get an opportunity to buy. So hope it helps, folks. I'll see you guys tomorrow. Take care.